All right, everybody's joining. Hey guys, thanks for joining us this Thursday for our live webinar. I'm Leah College, the Director of Real Wealth Realty, and I'm joined today by one of our go-to and long-term lending experts, Caeli Ridge from Ridge Lending Group. Hey, Caeli.
Hi, Leah. Good to see you.
Good to see you always, and so grateful to have you on to teach what I think is going to be a really powerful, mind-blowing class for some. If anybody on the line or anybody watching this replay has never heard of the all-in-one first lien HELOC loan, get prepared. We are going to blow your mind. This is an incredible tool, and it fits so well into the education that we've been providing over the last couple of weeks. We've been talking a lot about how investors can look at the properties they already own, the investments they already have, or even their primary, and look at the equity that's in those homes and consider how that equity might be able to better serve them to buy more properties in most cases. And so if you've been following that education, chances are you've been looking at the properties you already own and calculating your return on equity. And I'm hoping you're itching to do something. And we've talked about several different options that you have to tap into that equity and deploy it to better use. And we've asked Caeli. Caeli is the queen of the all-in-one loan, in my opinion. She does a great job of teaching this loan product. It is a little complicated, so you're gonna have to keep your brain engaged today. But we've asked her to come on to talk about this really powerful loan product that can be used on a primary home, it can be used on a secondary home, and it can be used on an investment property. So without further ado, we're going to jump right in today. I'll cover a couple housekeeping items and then we will jump right in. There we go. Okay, upcoming webinars. Here's our schedule for the next couple Thursdays. Next week, we're going to be doing another education class taught by our Indianapolis property team. They're going to talk about tips for creating compounding interest and big returns over time. They're going to be getting us thinking long-term with our investments and how we can really harness the power of compounding interest. The following Thursday, we're going to be talking about our newest syndication offering, a partnership with our San Antonio team, who our members are buying properties from. They look so good. We've decided, hey, we're going to do a build-to-rent community with this team and syndicate the deal. So if you want to be totally passive in your investing and you want to invest in the San Antonio market, this is a syndication you absolutely want to jump in on, and we'll be giving an overview on that. This is the second overview on it. I think the first one was just last week, so the replay is already up on the website. But if you want to join for the next live one, that's the following Thursday. And then October 17th, we're going to be joined by our Jacksonville property team for a property showcase featuring new construction, single family and multifamily investments. So the registration for these 3 webinars is already up on the Realty portal. So if you scan that QR code there, you can register for the ones that interest you. And we have some upcoming tours. This is our fall schedule. We have finalized all these dates with these teams. If you are curious about any of the markets you see here, Cleveland, Dallas, Indianapolis, San Antonio, or Jacksonville, Florida, tours are the best way to get familiar with a market, meet the team, look them in the eye while they talk about their properties, meet the property managers, talk with other investors who are considering or already investing in that market. These are fun. And I've got to tell
I've
you,
been on them. They're fun. I
I've
can
got to tell
attest.
you. Okay, good. They're a good time. Our teams know where the good spots are, and they almost always take us somewhere excellent for lunch. And we usually do a happy hour the night before, so it's a great time of connection. And I'll tell you, the one in San Antonio on November 2nd, the entire Real Wealth staff, we're all going to be there. Rich and Kathy take all of us for an annual company retreat, and we were talking about where's a really fun place to go, and San Antonio is a really fun place to go. So we're all coming to San Antonio, and we're all going to be on the tour together. So if you want to hang out with all of us Real Wealth folks for a real good time, register for that San Antonio tour on November 2nd. So again, scan that QR code there to be taken to the registration page where you can register for any or all of these tours. Okay, so if you are joining us live, one of the best parts about joining a live webinar is that you can interact with us. Caeli and I are going to have a dedicated Q&A session at the end. I'll monitor questions as they come in. So if we're on a relevant topic and we want Caeli to expand a little bit on something, shoot those questions over. I am watching them. We'd love to interact with you guys. So this is our standard disclaimer. The strategy we're going to talk about today, while it is an awesome one, it might not be suitable for your specific situation. So keep that in mind. This has to make sense for you. You should be consulting your own accountant, tax advisor, and/or attorney to discuss your specific situation. Past performance is no guarantee of future results. Real estate purchases are subject to investment risks, including the loss of all that you've invested. So while we do think this is a powerful loan product, Caeli is an excellent team to execute it for you and get you into it. Please know that the possibility of errors is always there. So as we always say, you are in the driver's seat of your due diligence for all your investments and how you get into those investments. Okay. So Caeli, let's jump right in. If you want to pull up the slides from your end, and then maybe start off by giving us a little bit of an introduction to who is Caeli Ridge, how did she get into this specialized niche of lending, and tell us about your company.
Yes, ma'am. Thank you, Leah. Thank you for having me. I really appreciate what Real Wealth does. Similarly, Kathy, as you know, Kathy and I go back many, many, many years, 20 plus, I think, at this point. And what I really love about Real Wealth, just briefly, is that you guys focus so much on education, and that is so resonant in what we do here at Ridge. We're all about education first. I think that especially from the lending side of real estate investing, you guys, it's lacking, really lacking out there. And whatever you can get online is either not relevant to what you're asking, what you need, your goals, your qualifications, it's outdated, or it's just bad, wrong information. Without the leverage, our rate of return is diminished. So I just think it's so important to have somebody or an advocate in lending that can provide a look under the hood, as I like to say. So really love that Real Wealth does all the education. That's really close to my heart and what we do here. So as a value add, you're going to hear me talk about education, and that's what we're here for today anyway.
Yeah.
So on my screen, Leah, I see show my screen. Am I going to do that, right?
Yep.
Okay.
And I'll
My
add this little
screen.
anecdote. I mean, Caeli, I connected with you first when I was a member of Real Wealth, a brand new member of Real Wealth. My husband and I were living in Europe and kind of at the very beginning of like wanting to really scale and do it really effectively and not misstep all along the way. And we were introduced to you personally, and I did really appreciate that initial call that we had where you kind of helped us jumpstart and really think about what we were trying to build long term. Not just any lender can help you get the next loan, right?
Sure.
Like to a certain point. But you really sat down to help us think like big picture, long term. How do we get all 10 of your golden tickets, as you call them, maxed out before we start looking at these alternative loan products?
Yeah, thanks, Leah. That means a lot to me because it's exactly what I have built after 25 years of being in this space. We've really tried to be holistic and not transactional. And as a result, just tapping into what you said, having all the education and that one-on-one with our clients is hugely important, and building that trust and that relationship for not one transaction, but many, many transactions. Because think about this, you guys, as your qualifications change over time, we're investors. We're not just buying or refinancing our primary residence, which is kind of a one and done. I mean, certainly we upgrade or downgrade and refinance occasionally, but as investors, we're buying and refinancing and 1031 exchanging, et cetera. So our debt to income ratio and our assets and our credit, all of those things are going to be a fluid moving target sort of. Understanding how, from an underwriting perspective, those things can change, and then how to optimize them. How do you read a Schedule E from an underwriter's perspective? That kind of stuff. So it's one of the things I'm proudest of in terms of that value add from Ridge. And then very quickly, you guys, I'm not going to bore you with my resume. We can have other conversations. I've been doing this 25 years. We have a very diverse menu of loan programs, the Fannie Freddie's, bridge loans, the all-in-one that we're going to talk a lot about, well, all about today. We've got commercial for residential, commercial for commercial, DSCR loans. It's quite diverse, as I said. So very rarely do we have a situation where an investor comes to us that we cannot provide financing for whatever their needs are. So that would be value add number two: education, diversity of loan product. my experience in the business, but I think also what I just want to share with you guys, because I will often give a little bit of my experience and advice. I'm a real estate investor. I've held many, many properties all over the United States. So I find that having both lenses and being able to provide some of that feedback, well, I hope it adds some credibility, like I say, but more than that, I want to impart to you my wins and losses. I've got plenty of both, so you can make more informed decisions. So enough about that. I'm just going to get right into this. And before we jumped on here, everybody, we had a quick conversation, Lee and I, and there is an interactive simulator. So this is the PowerPoint, the slide deck here. Um, I might go through just a little bit of this and just kind of give some verbal explanation. For those of you that are not familiar with this concept whatsoever, I may slide through this quickly and then get to this interactive simulator where I'm going to be sharing screen and show you what this looks like. Because as Leah had mentioned, in terms of understanding conceptually what this is, the learning curve is tough. I want to just quickly share with you. I know what I'm talking about. I've been doing this for a very, very long time. I know finance very well. I think after 25 years, if I didn't, I'd have some bigger problems. But my point is, when this was first introduced to me many, many years ago, I had to look at this dang loan for 2 weeks every day before I was able to connect the dots. So when I talk about this on a day-to-day basis, I probably have 100 of these conversations a day. I want to make sure to set the expectation that this is probably not the first time. Again, if you're new to this concept, the first time you're going to have to hear it. You're probably going to have to hear it several times. But that simulator that I think I'm going to jump to in a minute, I think will be really useful at connecting some of those dots and getting you along in understanding. So what is the all-in-one? Okay, guys, if you've ever heard of the concept velocity banking or infinity banking, if those terms are familiar to you, or maybe you know what whole life insurance policies do, this is similar, okay? It is a first lien HELOC. So when you say first lien, that means when you guys think about HELOCs, a lot of people will just default to what is a second lien HELOC, right? You have your first lien 30-year fixed mortgage, and then you think HELOC is probably that second lien mortgage. That's not what this is. This is a first lien HELOC. So whatever you have, if it's not free and clear, if the property's not free and clear, if you have a mortgage on it, this loan will replace what's there. Now, for those of you that are thinking, well, I've got a 2% interest rate that I got during the pandemic, I want you to just take a pause and please, for this conversation at least, forget what you think you know about interest rate. The psychology of the actual number and the rate, I want you to remove that from your brain if you can for a moment, okay? Because for the right individual, it won't matter. So the simulator, I'll get to it in a second, the math won't lie. Okay, when you punch in your information, and we'll get you a link to that, I'm sure, at some point, so you can do it for yourself. When you plug in your information, okay, it's going to be comparing this first lien HELOC all-in-one to what you have now. The results page will be very clear if you're a good candidate for this or not. And in comparing, I do the simulator, I'll get 2% interest rates. And for the right individual, this HELOC that is fully indexed at a rate of 8.08 right now, come back to that later, crushes it. Absolutely crushes it. So again, please just remove what you think you know about interest rate just for a moment. And trust me, as we get through this, it really doesn't matter when you understand conceptually what the all-in-one does. Okay, so on this slide, what it's communicating to us is that the all-in-one it's called the all-in-one because it incorporates two functions. You have the mortgage in the form of an open-ended HELOC, and it attaches itself to your personal banking, your checking and savings. Okay, that's why it's called the all-in-one. And just in case, okay, I want to give this definition. A fixed rate mortgage, the one that we are kind of preconditioned in the US to understand, is where you have amortization. Okay, that is where you are monthly making payments that there is interest and principal based on the initial loan that you took out and the interest rate that you secured over the term, whether that, let's just use 30-year fixed because that's the most common. So over 360 months, okay? Monthly you're paying, part of your payment is gonna go portion to principal and part of it's gonna go to interest. Whereas the HELOC is open-ended. This is interest only, okay, on the all-in-one. The other thing too to remember, most of you probably are familiar with this, when you think about a 30-year fixed mortgage, the first, let's say 10 years of that mortgage, how much of your payment do you guys, if anyone's looked at an amortization table, you know this, but how much of that principal and interest payment that you're making every month, how much is going to the principal in the first 10-ish years?
Very
This
little.
much? Yeah, this much. Very, very little. And the reason for that is because the powers that be, we have the benefit of having a long amortization that keeps our payments what? Lower, right? Our payments are going to be much lower as a result of having a full 30 years amortization.
Mhm.
But because they want the
The
lending
money.
institutions, right? They want their interest. You're going to front load that with almost entirely interest. You're not going to start paying your principal until the back end of the loan. And the other reason that that might be important, and I don't want to get off too far on a tangent here, but statistically speaking, and you guys do your own research and look this up, the average shelf life for a 30-year fixed mortgage, and this kind of plays into your 2% interest rates that everybody has secured over the pandemic, even with those low interest rates, I can guarantee you that the percentage of people that will start with a 30-year fixed mortgage, especially on a rental property, and then make 360 payments later to pay that thing off, is a fraction of percent. I don't care what interest rate you started with. It's highly unlikely. And maybe you're an exception to the rule, okay? But highly unlikely you're going to keep that mortgage for a full 30 years. Whether you refinance it to pull cash out and harvest equity, you sell it, whatever, it's highly unlikely. Okay. This isn't super important. Just briefly, the US is kind of behind the times a little bit. And when it comes to this concept, it's been mainstream in much of the rest of the world. The US is, it's, a lot of people don't know about this. And I have some conspiracy theories about it. I think it has to do with the GSEs, government-sponsored enterprises, Fannie Mae, Freddie Mac. Trillions of dollars are made in interest within that socialist program, which, by the way, don't make any mistake, those loan products are socialist, FDR, never mind, I'll move on. My point is that most of the rest of the world has been utilizing this concept effectively for many years. The reason that it's not more mainstream here is you can interpret how you want there. Okay, so I'm going to try and paint a picture, you guys, and outline exactly what this is and how it's going to work. So this is interest saved. Okay, when you think about interest that you would earn, right, that's pretty obvious. This is interest saved. And there are compounding effects too, specifically, two compounding effects at work here that are going to be saving you interest by utilizing this principle and this concept. Okay, so because we've got this open-ended revolving line of credit that is your line of credit for 30 years, by the way, and it couples with your checking and savings account, when you combine those two things, it is such a powerful tool because on any HELOC, okay, any HELOC, the interest accrual is based on the daily balance and that month's fully indexed rate, okay? So if you know that you've got your depository accounts attached to this line of credit and you're utilizing it just as you would with what you're doing now, dollar for dollar, all your depository income is going to go into this checking and savings account where the HELOC lives. So dollar for dollar, that balance in the HELOC is going to be driven down. And the longer you leave that income in against the balance, the less interest you're going to pay. Okay, so you've got the daily interest savings, there's compound effect number one, and then you've got the monthly residual, AKA monthly leftover, monthly savings, that's gonna sit in there and ride while you're not utilizing it. Compounding effect number two, because it's gonna continue to drive that balance down. So let me give you that verbal example that I think is helpful for that mental picture. So I want you to imagine that you have an outstanding balance on your line of credit, on your HELOC of $100,000, just for round numbers, okay? And we're also gonna say that you make or bring in all depository access, $10,000 a month, okay? From all sources, and I mean all sources. So that would be gross rents, because that's the other thing about this product that's so great for investors is that most of us have access to 2 grand, 5 grand, 20 grand, 30 grand a month of gross rents that before we make mortgage payments or whatever other expenses might be applicable, we have access to those gross rents. So gross rents and then net of everything else in the deposit section. So net W-2, commissions, bonus, child support, alimony, social security, dividends, interest, right, as those apply to you. Net of all of that and gross of the rents, okay? In this example, we're gonna say that's $10,000 a month. And just to keep it simple, we're going to say that you make that 10,000, you get that full number on the first of the month. Obviously, that's not applicable to most people. It's received throughout the month, but we're going to say you get it on the first of the month, just to keep it easy. So you have $100,000 in this line of credit. That's your balance. You make $10,000 a month, you get it on day one of month one, you drop it into your account. What happens to my balance? My $100,000 balance is now immediately $90,000. You're going to leave that $10,000 in the account for 29 days out of a 30-day billing cycle. You're not going to touch it. Well, what about all of my living expenses? What about all my bills? What about all this? You're going to use a credit card or credit cards of your choice to pay for everything. Down to a stick of gum is going to go on that credit card. Now on day 30, because you heard me say 29 days, right? On day 30, before the credit card accrues any interest, you're going to go online to where your 10 grand has been sitting. And by the way, this checking account is an FDIC insured bank that will house this. Completely automated. Everything that you guys have with your Wells or Chase or B of A right now, exactly what you're going to have here. So you're going to go online to where your 10 grand's been sitting, excuse me, and you're going to pay off all of the bills that have amassed on that credit card. We're going to call it $9,000. $9,000 has been put on the credit card, and on day 30, you're going to go online to where your 10 grand has been sitting, and you're going to pay that credit card off. Okay? So what's left over? $1,000, right? $1,000 is left in there. While it's sitting idle, right? What is it doing in your checking and savings at B of A right now? Nothing, right? You're earning what? Nothing. A percent, 2% a year, whatever it is, it's virtually nothing. So instead of it being there earning and doing nothing, we're going to leave it in here, 24/7 access, to drive that balance down and reduce the amount of interest that can accrue over time. So now I want you to think and fast forward to day one of month two. So we're starting the month, instead of $100,000, what are we starting with? 99,000 is our balance because we still had $1,000 left over from the prior month. That's compounding effect of interest save number two. So month two, day one, our outstanding principal balance is 99,000. I get my $10,000, I drop it in there, and now what is my outstanding balance for the 29 days of month two? 89,000, right? So I'll stop there, I'll pause there because you guys can probably see where that's going, but those are the two compounding effects of interest savings. You will never pay more interest than what the principal balance is for that month or that day and what the fully indexed rate is for that month. So for those individuals, just to kind of take this to the next level, I already went over that. I don't really need to do that. Take this to the next level. For those that have idle cash, think about this too. So go back to my example. I'm going ahead, you guys, hold on. I'll come back to this in a second. So those that have, let's say you've got 50 grand in just cash, kind of sitting around that isn't being deployed, not being used for anything at this point in time. And go back to my original example. 100 grand is the balance, and you've got $10,000 a month of income. Well, this 50,000 bucks is sitting over here doing nothing. You're going to drop it in, right, from this account, this checking savings, and you're going to drop it into this checking and savings, driving that balance down even further and saving all that interest. I have clients, check this out. I have clients that have enough disposable at any point in time for most of the month, let's call it 29 days of the month, where they pay almost zero interest on the mortgage. And why is that? Because you will never pay interest on equity that is not being utilized at that point in time. So the more you can drop in there, the longer you can leave it in there within that 30-day billing cycle, the less interest that you're going to accrue, okay? And that's how this works in the power of having access to this line of credit. You guys have created a scenario where you've become your own bank, okay? All right, let me check out these slides and see how much of this. Let's go over some of the logistics. So this is a 30-year line of credit. I think I mentioned that before. If you know terms on a HELOC, more often than not, if you're familiar with that, you probably have a 3-year draw. Maybe you have up to a 10-year draw, interest only, and then it shuts off after a certain point and it becomes a principal and interest, right? You don't have access to it anymore and it's not interest only. You got to start repaying that debt, right? Well, this is very, very unique. It's one of my favorite features of this loan. It is a 30-year line of credit. What happens is that in the month one of year 11, the limit, the high credit limit will start to reduce very slowly. So think about this. First 10 years, totally unchanged, okay? And then the remaining 20 years of this 30-year line of credit. So if you think about 20 years and how many months are in a year, 12 times 20 is 240 months, right? So in the first month of year 11, the limit is going to go down by 1/240th%. That 240 is representative of to the number of months that are left in that remaining 20 years or that trailing 20 years. Okay? Now, because you can never owe more than the limit, your balance can never exceed the limit. That's how repayment works. All right, and we'll take questions on this. For qualifying purposes, I may come back to that. We'll talk about that later. Loan amount, initial draw, I don't think you need that. Why don't I jump, you guys? Let me talk about the rate and then I'll jump to the simulator. So this is true for any adjustable rate mortgage, whether it be a 5-year ARM or a HELOC, a second lien, a first lien, it doesn't matter. Any adjustable rate mortgage where the interest rate is subject to change is comprised of 2 numbers. There's an index and a margin. The index is variable. That is the number that can change. And there are dozens of indices out there. You guys are probably been seeing all the headlines about the Fed fund rate. That is an index. That happens to be the daily intra-trading rate between banks. That's what the Fed fund rate is. You've probably heard of prime. That's an index. The index that this loan is tied to is the 1-year CMT. That stands for, or that's the US Treasury. Okay, 1-year CMT, that's the index. It is currently posting, well, I have information that says as of October 1st, it's going to post at 4.08. September 1st, it posted at 4.38. So you can see it's on the run like the rest of the indices and interest rates that I'm sure you guys will have questions about later. So as of October 1st, the 1-year CMT will post at 4.08. That's the index. That one can move. And then the margin is the second number, index and margin. The margin is fixed. It can never change. It will never change. If you have this loan for a full 30 years, that margin is fixed. It will not move. So when you add those 2 numbers together, index and margin, you get your fully indexed rate. This rate can adjust up to one time per month. In knowing that, I know a lot of people, oh, it can change once a month. I will get back to some of the security of that. Okay, there's a floor rate and a life cap that we'll get into in a second. But just in terms of how you're going to calculate interest, remember it's based on the fully indexed rate and the daily, not monthly, the daily principal balance. Okay, and whatever that interest accrual is on that day, that's gonna take a snapshot for 29 more days of that month, and then it'll add up together how the interest accrued for that month based on those factors. Okay. Let's go, I'm gonna go to the all-in-one, I think. Let's just do the simulator, you guys. We'll get back to, let me see if there's anything else in here that I think would be super
The
useful.
slide that I love was you have one in there that talks about who is the ideal person for this, because that was kind of when my light bulb came on. Yeah,
Okay.
who is this for?
The easy answer is that, I guess I can put this back in slideshow so it looks a little more professional. Sorry, guys. So I would say that on average, okay, and I really think this is a one-on-one conversation, so please feel free to reach out, everybody. But if you've got about 10% in residual every month, with whatever you've got coming in, if there's 10% left over, more often than not, the all-in-one will be the right fit for you. That's just the general overview rule of thumb.
Yep. And
And I
then I
think
felt like there was a certain type of property that was almost ideal for this too. I felt like it to justify it and to really be powerful, it needed to be kind of an expensive property too. Would you agree with that?
I agree with that, and here's why. Generally speaking, okay, there's, like I said before, there's exceptions to every rule, but generally speaking, I think the all-in-one works best for the property that's going to have the highest value, and generally the owner-occupied, because the owner-occupied in terms of the guidelines and allowances lets you leverage at a higher percentage than an investment property. So
Mhm.
for those 2 reasons, that's going to give you the highest line limit, and I think that for all intents and purposes, I think you want the largest line limit that you can have for the reason I described a minute ago. You've turned yourself into your own bank. So
Right.
I'll give you an example. Let's say that your investment property is, I can't do mental math, so let me get my calculator ready. Let's say the investment property is valued at 250. Well, the loan to value on a cash out refi, we can do purchase, rate and term refi, cash out refi. But on a cash out refi, if the value of the property on your rental is 250, 70% max loan to value, that would give you a line limit of 175,000. Let's say your
Mhm.
primary residence has a value of 750, okay, 750,000. Typically, our homes that we live in are going to be higher value. Times 80% loan to value, you've got a $600,000 line of credit. So
Right. Yeah.
exceptions to the rule, but generally that's what I would say. The best property is usually going to be the primary
Hmm.
80% of the time.
So you're not doing an all-in-one loan on one of the investment properties more than likely that you bought from a real wealth team a couple years ago for, 150 that's now worth 250. That's probably not the one that you're going to do the HELOC on. It's probably if you have a vacation property, on the beach somewhere that's high value, or like Caeli mentioned, your primary is high value, or maybe you timed the acquisition of a quadplex just perfectly and it's worth a million and a half now. That's the property that I think you're going to want to be looking at for this loan product.
For optimization, I agree. To
Yep.
maximize the
The
use of it,
benefit.
agreed. Yeah,
Yeah.
yeah. Um,
And you
and
wouldn't
while I'm
and
on,
you
yeah,
wouldn't necessarily do this loan, Caeli, right? Unless you're planning to use the equity, right? Like you would you go through all the trouble of it if you weren't planning on redeploying the equity into other purchases?
there's so many value adds about the all-in-one. I mean, there's so many reasons that it just kicks a closed-ended amortized mortgage's butt.
Yeah.
But ideally, yeah, especially for those on this call, investors, it's such a huge life-changing tool for so many people. But even if you weren't going to redeploy, I think yes, you're going to want to utilize that equity. But now it's available to you guys for without having to pre-qualify every couple of years to pull cash out. You're not paying closing costs again. You're not going through the loan process again. You now have access to this line of credit. So to do that and to reinvest, I think is the obvious use of it. But check this out. Here's another just kind of subset or byproduct of why this is so great. And this is where people really get confused, and myself included when I was first looking at this. Stay with me. There's no payment due. There's no payment due on the all-in-one. The only time an actual deposit is mandated is when your balance, what you owe, is about to exceed your limit. So imagine this. Let's say that you have a limit of $500,000. You've got a line limit of $500,000 and you owe 100 grand. That's the balance. You have a $400,000 spread there to do what you want, when you want, how you want. God forbid something happens and you lose access to any sort of incoming income. You got nothing. You don't have to make a deposit into this account. It's your account. It will obviously continue to accrue interest, but if you needed to pull cash to pay for college tuition or whatever it may be, that's your equity to use for whatever you want. And let's say that you just need it for living expenses for a couple of months because of whatever circumstances happen. You can certainly pull from it to live off of for whatever amount of time that you needed to. Again, the balance is going to go up because interest accrues, but so what? Well, you're getting back on your feet. You do not have to make a deposit in that loan until mandated until the balance is about to exceed. So there's a safety net there, a really impactful safety net as, like I said, a byproduct of the value of this loan.
Mm-hmm.
Yeah.
Yep. I hope everyone's still with us. Give us some affirmation if you're still following this before Celia jumps into the calculator. The calculator honestly was what when my husband and I sat down and really looked at this was what when you look the numbers in the face, you're like, okay, I can't deny. Yes, it's a higher interest rate, and that's what everyone gets hung up on, to Caeli's earlier point. But when you see how much you save over the term of the loan and the fact that you've been able to use the equity to purchase more assets all along, I mean, it's yeah,
Huge.
incredible.
Okay, watch this, you guys. So this is the simulator. Again, I'm sure that Leah and team are going to give you access to the link here. You can go to Ridge Lending's site as well. It'll be right in there. So we're going to do a new simulation. I'm starting you from the beginning. So if you want to follow along, feel free. You can see you can see the website there if you want to do it with me. So we are going to go and do a rate and term refinance. We're going to compare. So what I think is kind of powerful is I just want to show you a simulation that I've done recently on a primary residence, and I'm going to compare it to your 2.5% interest rate. Okay, so primary, and then when you do the comparison type, we are going to compare the all-in-one to an existing loan. Okay, this is what the person has on their mortgage right now. Property value is $1 million, and they owe 500,000. Okay. We're not even talking about yet the availability of equity that they would be tapping into and utilizing for more returns, more investments. This is just taking what you have right now and showing you how it would match up to the all-in-one if these were your particular numbers. So it's a 30-year fix we're going to compare to. Let's use 2.5 and see what happens. And like I said before, you guys, the math won't lie. Okay, if you input accurately, and I'll show you what you're going to be looking for in a second, it'll be very clear on the results tab whether or not you're the right candidate for this. I would suggest that we do it together to make sure, but that's another conversation. Okay, we're in 2024. Let's say that this is 36 months old. Okay, you got this loan 3 years ago. These are the terms that it's on. So what the simulator has done is it has taken this $500,000 at 2.5% over 30 years, and it's 3 years old. This would be the principal and interest payment on that mortgage today. Okay, principal and interest only. So when you do this and you look at this, if this is within a few bucks of what your real principal and interest is, it's fine. If it's significantly different, you've done something wrong. Okay, it's probably here in the age of the loan in months, but otherwise that's right on the money. If you have a second lien, and or let's say that you want to compare the all-in-one, you don't want it, you just got this psychological holdup on keeping your 2.5% or whatever it is, you just can't get rid of it, fine. Then what I want you to do is I want you to take a minute and see what would it look like if I added, instead of doing this, I'm going to add a second lien. I'm going to pull out a $200,000 HELOC, second lien HELOC. Make sure you put that in here. So you would go, in this case, I'm going to remove this in a minute, but you would say, let's say you're going to pull out 200,000 bucks. You're going to compare it to a 10-year HELOC. That's the most common. Let's say interest rate is at prime. Okay, 8% right now, and you're just going to get it. It's in month one. You're going to do it at the same time. That would be your interest-only payment. So if you wanted to compare and keep your first lien and get a new second lien HELOC, go ahead and plug in those numbers. Okay, I'm leaving that 0. Let me make sure it's saved my changes. Good. Next. Now this is where a lot of people get hung up, and I find that they're not understanding what the simulator is asking for. They're interpreting it wrong. So they put in the wrong values, and of course the results aren't going to be valid then. So what I have people do here is you've got repeating deposits, and you can continue to add them in there, and then you've got one-time deposits. I'm going to leave this blank, but when I was talking a second ago, if you've got idle cash, 5 grand, 20 grand, 100 grand, whatever it is that's just kind of hanging out for most of the month or what have you, you would throw it in here, and you would just define that by when it would be going in. If it's immediate, you'd put month 2. It says month 2 because it needs a month after you close to transfer servicing rights, etc. Or let's say that you know that you get $10,000 refund on your tax return every single year. You can simulate this to put 10 grand in there, and then what would that be? 4, 5, 6, 7 months, right? You can characterize it that way. So for the repeating deposits, if you can, and in our case, in my example, I'm going to do it this way, I'm going to lump everything together. The gross rents, remember I said gross rents. Now, if you self-manage, that's totally gross rents. If you have a property manager, make sure that they get their piece first, because that always happens, right? So you want the gross rents before anything goes back out the door. We have access as investors to utilize usually a substantial amount of money during the month to just let it sit idle here. So remember, you're replacing whatever checking and savings that you have now for this fully automated checking savings here. So gross rents and then net after taxes from every other source. So this individual's got 20 grand come in the door, okay? And it's monthly. Now you can see by the frequency, you guys can get real specific. You can add the repeating deposits if you want to. I'm lumping it in one. This is the more conservative way actually to look at it. If you did this as it really lived in reality, you'd do it differently with frequency and the different amounts. So I'm just doing the one. We're not doing a one-time deposit now. This is the final page before we get to the results, okay? The simulator will default to 1.5% of the value that we put in here. That's what that number is, okay? So I'm just gonna leave it. And then the final thing that you have to come up with is how much is left over? You got $20,000 going in here. How much do you have in that monthly savings every month on average, okay? I'm gonna throw in 20%. Okay, so this individual's got 4 grand left over after the 20,000 goes in there. Okay, now the simulator assumes the following. This is important. So if you guys are writing down or transcribing all this, I want you to stop and listen to me. The simulator assumes that in addition to this 20 grand sitting in there for 29 days of that 30-day billing cycle, that this number, what you're currently sending out to Rocket Mortgage or PennyMac or whatever it is, this number and this number, so that would be 61.23 and 74 cents, are being left in the account. The simulator assumes that if you were to replace your existing mortgage with the all-in-one, that this that is currently going back out, you're not going to be utilizing it for some other living expense, right? It's not going back out the door. It's going to live in here now, along with this. So those two numbers are going to be sitting idle in this account on average month after month. 24/7 access, you guys. What would happen? Let me ask you a question. What would happen if you sent in your $2,000 a month mortgage payment that you send to let's just keep using Rocket, whatever, and your $4,000 left over, you decided to apply it every month with your 30-year fixed mortgage?
It's gone.
Why would you never do that, right? You'd never do that because you couldn't get it back. It's no longer liquid. Here it's liquid. Okay, so the other thing now, remember, I'm just comparing, what time do we have? I'm just comparing what you have now. We're not even looking at this thing yet from the eyes of access to the equity and what it can do for you in making more acquisitions and returns, et cetera. But that's where this would come in. If we have time, I'll come back to this link, because as you saw before, that one-time deposit that we want to put in there, we can also account for one-time future expenses. So if there's equity in the account, I can say I'm going to take out $25,000 in month 12, and in which case I'm going to buy another investment property. Remember, if you're going to do that here, what would that, if I do this, what is it going to mean to me monthly? I'm going to have another return, right? If I take $25,000 and I go buy it and put it down on an investment property, I'm going to have gross rents of $1,000, whatever. So if you do it here, make sure you put it back in the deposits page. Oops, I don't know why it does that. 20%. Okay. The unveiling. All right, I'm going to change one thing and then we'll come back and I'll show you the results. So the simulator, let me tell you how I got here, sorry. So on the results page, rates and assumptions tab, the simulator defaults the rate trend to remain at the initial fully indexed rate, which currently is the 8.380. This will say 8.08 in about 4 days. Okay, it's still September, so it won't update until October. But this assumes the rate trend is it stays at the initial fully indexed rate. It assumes that interest rates don't change and they don't move. That is not an accurate way to look at this. So while I am always very conservative on this thing, my advice would be is to look at the historical average rate. So remember I talked about the 1-year CMT, the index that this is tied to before? The simulator has 25 years, okay? 300 months of data collected on the 1-year CMT that has said where that has posted every single month. So the historical average is really the way that you want to look at this.
Okay.
All right, I can come back and answer questions on that later if you guys want to. Okay, so 500,000, 500,000. We've got this 500,000. If we were to have lived by the numbers that we put in here, will be paid off in 9.2 years versus the 27. Because remember, we've got 3 years on this loan as it is. In this particular case, with this person's scenario, you're only saving about 16,000 in interest, so it's not a huge number. But let's play with this a little bit and see. Maybe somebody's got 50 grand. They would sit idle in here while it's not being utilized. Let's see how it changes the numbers. Okay, now we're saving interest. We're paying off in 8.1 years, so you can see how that moves the needle. Anyway, why don't Leah, is this a good time maybe to take a pause and see if people have questions since we're 15 minutes left to the hour?
No, I think we're okay. Everyone was affirming that they're with us. There are a few questions,
Okay.
but this is really awesome to see. So
Okay.
we grip tight to our 2.5% interest rate, but seeing that we could, because it's saying that the payoff is in 8 years as well. So not only are you saving on interest, but you have a free and clear home in 8 years versus 27 years, right?
Right. Yeah, with a line of credit that you can continue to grab at and utilize at your leisure. So real quick, I want to show you guys, when you're in here, if you want to save your work and go back to it later, you just simply go here. There's a key code, okay, that you can use. And then when you go to the get started, it'll ask you to put it in here. Okay, let's do one more. Let's say it's on a new purchase, okay, at current interest rates. Now that was the 2.5% interest rate. Watch this. Let's do one more. We're going to go purchase. I'm going to go primary. We're going to compare to a new traditional, right? Before we compare to the existing, I'm going to use some of the similar numbers. And let's say that the purchase price, I'm just going to keep using the same stuff, is $1 million. And we're going to put 20% down. You can actually go 10% down on this, but we'll just use that. We're going to compare it to a 30-year fixed. Let's be real generous with a 30-year fixed owner-occupied purchase right now of this level. Let's say that you can get 5%. I don't think that you can, but let's just say I'm just using that as a number, okay? And everything else that we had in here, I'm going to do the same. So we've got 20,000 coming in. This is monthly. Leave that the same, and we've got 20% left over. Let's say 10%, okay? So the simulator is going to assume, remember guys, that this number, this is the principal and interest payment using 5%, 800,000 on 30 years. It's going to assume that this number and this number is what's left over every month that just rides in the account. You can access it whenever you want without condition. Hold on a second. Go here. So looking at it side by side at a 5% interest rate. So here, let me just real quickly. So the left side of all these different tabs, if you guys come in and play and you see a left side and a right side, the left side is always going to be the all-in-one. The right side is our 30-year comparison. So there's our starting 800,000, same. Total interest accrual based on these values, these numbers. And remember, I only had 10% savings in here, okay? I'm just for fun. I just want to make it look pretty cool. Let's go 20%. Okay. So you're going to pay off $800,000 in about 11.7 years. The total interest accrual based on our values is about 346,000 versus 746,000. Okay, 140 months versus 360 months. Then these final numbers here, the two numbers above, the principal and the interest equals the total expenses. Come on, mouse. Total expenses here, total expenses here. The difference between those two numbers would be $399,000 in saved interest between these two scenarios, which
Yeah.
is pretty cool. Let me show you one more screen. Well, I think that'll confuse everybody. Yeah, maybe I won't do that. Let me talk about the life cap and the floor cap real quick when we talk about interest rates, because that's usually where people's minds, no matter what happens, everybody wants to kind of focus on that interest rate. So the fully indexed rate, remember, we've got a margin and an index. So this number currently posted here, plus there's that margin, those two numbers added together, 4% plus 4.38 as of the 1st of September is 8.38. On a primary residence, different than if it was a rental, the floor rate is 3.75. So what that means is that for 30 years, if this went negative, and indices have gone negative, okay, that's happened before. But if this went to a negative half, right, if this index said negative half, if you take a negative 0.5 and you add it to a positive 0.4, you'd be at 3.5, right? It wouldn't matter if that were the case because your floor rate could never ever, the interest that is accrued could never be less on a primary residence than 3.75. So if this went negative by a quarter, you're at your floor rate. If it went negative by more than a quarter, it won't matter because you will never pay less in interest than 3.75. That's the floor. The flip to that coin is the cap, the life cap. So also for 30 years, you will never pay more than what this life cap is. And the way that that's calculated is we're going to take the initial fully indexed rate. So depending on when you close the loan, if you close this in October, this number is going to say 8.08. You take 6% plus 8.08. If you were to close it today on the 26th of September, you take 6% of 8.38, and there is your life cap of 14.38. So no matter what happens with this guy, you will never, ever, ever pay more than 14.38%. That is the life cap.
Got it.
I'll take a pause.
Yeah, I just thought of a question. Okay, so the question of how many of these do you do? Like, are you just getting one all-in-one loan and getting all the benefit of all the incomes going towards the one, or is there a world in which it makes sense to have a couple of these?
Depends on the individual, I would say. I'll exit out of this. How do I get back to us? There we are.
That's third tab.
So, did I do it right?
Click on that
No, sorry.
webinar tab, the third one that you have open. Up,
The
up, up,
third one that I have open,
up.
there it is. Web,
Do you see the webinar one?
no.
Oh, it's
Webcams.
the go to the PowerPoint orange box with the white in it. Go
Okay.
up at your tabs that you have open at the very top. There you go.
Okay. So who would it be advantageous for somebody to have more than one? Maybe. Okay. depending on the individual's depository access and what they have left over. But if you think about it, more often than not, most people, it'll be counterintuitive for them to have more than one of these, because if you have $20,000 a month and that's your number, depending on the other numbers, you have to split it up now. You've got two all-in-ones, right? So maybe 40% of that 20,000 you're going to put here, and 60% is going to go here, and then whatever the monthly residual is or leftover is will be split up differently, et cetera. So it may not be to your advantage to have more than one,
Hmm.
or it may be. It really it's going to be an individual thing that dictates whether you should have more than one of these or not.
Hmm. But if you're out there and you have dual income in your household, you both get big old paychecks, you're building, large real estate portfolios, it might make sense to leverage this loan in
Heck
multiple
yeah.
properties.
And you're eligible, just FYI, for qualifying purposes, you're eligible to have up to 3 all-in-one mortgages. One primary, one rental, one second home. But if you're married or you've got partnership or whatever, you could have, I guess, up to 6, right? Each of you could have one of each if you had that kind of depository strength.
Awesome. Okay. It's amazing. Honestly, it is mind-blowing. And you didn't even touch too much on like your ability to recycle, your ability to redeploy the same equity. I mean, that's what became powerful for me when I looked at the calculators. It appeared that we had the ability to essentially recycle the same equity. I think it was 5 or 6 times,
Yeah,
and constantly redeploy it.
let's do that. So we're going to keep using this as our purchase example. Okay, someone bought a home, $1 million. They got their line limit is $800,000. Okay, so check this out, you guys. So if you look at I think it's this one. No, not that one. Here it is. So in the pay down table, it'll show you left side's the all-in-one. Here's our 30-year fixed. You'll be able to see that on month 14, you got 36,000, almost $37,000 that you could pull out and buy an investment property. Watch this. So let's go here. If you guys remember a second ago, I was showing you this one. So we're going to say that we're going to take $30,000 out in month 14, and we're going to buy an investment property with that money. Now, this is not 100% because this forecasts that I'm taking this 30,000 out in 14 months, but I want you to go back to the deposits and put in with that 30,000. Let's say that you're going to get a gross rents of 1,200, okay, a month. This starts immediately, so it does actually work to the simulator's advantage, but it's within a couple bucks. It's not going to be huge. I would say that you definitely want to put the income in as a result of taking that money out, even though it's futuristically calculated on when it comes out. Okay, so we've got $1,200 extra a month, and 20% of that is, right, 240 bucks. So that property is cash flowing by $240. You can change that by adjusting this here. So let's see what happens when I do that. So we've lost a little bit in the interest savings. I think we've added a few months of time to pay off, but we have another property now that we
Hmm.
didn't, you know what I'm saying? That you didn't have to go pull cash out of somewhere to get it. This is, I mean, think about the tool that you guys have at your fingertips. I said this, I think, earlier in the webinar. You have become your own bank, guys. Think about how powerful that is.
Yeah. Tack on a couple months in the payment, but I got a property
Right,
without really having to rely on any additional income.
right.
Okay, Caeli, we've got some questions here. Let's chip away at some of these. Um, the fir- the first being, how do we get in touch with Caeli? We'll get Caeli's contact information up on the slide, but Caeli is a resource listed up on our resource page under lenders. You'll see her listed there. Her team is awesome. You can get in touch with them. Okay, does the all-in-one count as one of your 10 Fannie Freddie loans?
Good question. Let's talk about qualifications. Yes, this is a recourse loan, and it absolutely will count as one of the 10. The guidelines allow us per individual, if it's for a rental property purpose, you cannot have more than, this is rental and second home, you cannot have more than 6 finance properties and qualify for the all-in-one and put it on a rental property or a second home. If it's
Mm.
your primary residence, I think you can have up to 20 finance properties without a problem.
Ah, goodness. What if you don't have a primary?
Yeah, you cannot have more than 6 finance properties right now and qualify for the all-in-one. They updated
Okay.
those. And I think that as we start to lose the quantitative tightening, as we start to loosen, and we think that those tides are turning, you guys have seen the headlines. In the coming months, years, I think they're going to re-loosen that. It hasn't always been the case. You could have up to
Mhm.
20 investment properties and get, if you could qualify in every other metric for the all-in-one, it was fine. But they really pulled that back during the pandemic.
Interesting. All right. Okay, here's a good question. Can you combine several rental properties in one all-in-one HELOC to maximize the equity?
I knew that one was coming and I should have just addressed it. The answer is technically no. This is not a cross collateralization loan. However, manually, yes. So check this out. So it will not, the lien will not encumber multiple properties. It's only ever going to be one loan per property. But depending on that property, and if you have the value and enough equity in it, whether to start or even down the line, you can utilize it to accelerate the payoff of that other debt in a much more meaningful way. So that now, I'll give you an example. Let's say that you got a $1 million line of credit, okay? And you've got these 3 rental properties here. You could stroke a check, and each one of them has $100,000 outstanding, okay? You can pay off every one of those with this line of credit on this one property. These are now free and clear, of course,
Mm.
and you are housing the mortgage debt on those 3 into this one. So in
Oh,
that sense,
interesting.
it's cross-collateralized,
Okay, that makes a lot of sense.
but they're unencumbered, right? You could go get
Right,
more cash out if you wanted to.
right. Wow. So take your illiquid equity and bring it into a very liquid account that you can use.
Yes, yes, and pay off much quicker. And run that simulator, you guys. So if you want to do that, if somebody wants to play with that, see if you have the equity in another property, or at some point, maybe it takes you 2 years before you have enough once you paid it down, you could then, and you could do it in $20,000 chunks if you wanted to, right? It doesn't have to be all or nothing. So if you
Mhm.
had 100 grand in mortgage debt on this property, it may take you 2, 3 years to pay it off, whatever, if that was your objective, because you're going to write checks out of the all-in-one, $20,000 a piece, and prepay that principal much faster, saving huge amounts of interest. Housing it
Mhm.
here, you can do all that simulation on the interactive simulator.
Okay, David wants to know what are the risks of this loan? What's the downside, Caeli?
I have not found one, and that's usually the first question I get is, well, okay, what's the fine print, right? What's
Yeah.
the catch? I don't know that there is. Actually, here's the catch. This is not a cheap loan. So this is the only thing I have been able to find about this loan product. If there is a pro and a con, if you think about second lien HELOCs, if any of you has ever gotten a second lien, that's kind of free money. It might be a few $1,000s, maybe. This loan cost-wise is every bit as expensive as any other traditional loan that you've ever received. All those third-party fees, the points, etc. This is not going to be a cheap loan. However, that said, I would tell you that typically, if you're a good candidate for this, you're going to find that the interest savings will be made up in typically the first 6 to 12 months of having this via the costs. So if the costs were
Mhm.
10 grand or 20 grand or whatever, generally speaking, you'll be able to quantify that the interest savings that you're going to get from the loan will be
Add up.
matched or repaid in
Yeah.
the first year, 6 to 12 months.
Is the price of it any different if you're doing it on an acquisition versus a refinance of a property?
No,
No.
no different.
All right. Can is it are you able to use this in every state?
We are licensed, Ridge is licensed in 49 states. We cannot do these in New York. And the only other exception to that would be an owner occupied in Texas. We can do every other occupancy, every other state. So we cannot do it in New York, period. And we cannot do primary residence in the state of Texas. Texas has got some really weird laws about lines of credit that are so outdated. Somebody that lives in Texas, if you're hearing this, get to your legislation body and tell them what in the hell you guys need to overturn some of that weird stuff. I don't even know what the issue is. Anyway, otherwise, yes.
That reminds me, someone asked the question when you had that map up there. They said, "Can we do a separate webinar to discuss conspiracy theories?"
Okay, I'm there. I'll bring mine. I'll bring my popcorn and my conspiracy theories.
I love it. Okay, Tom points out that this requires discipline. This loan requires discipline. Would
Yes,
you
Tom.
agree?
Yes, absolutely. That's a really good point. Because I'm sure, and there's a lot of scrutiny, which is a sidebar to this, and I'll come back to it. Um, the underwrite and the qualifications to get this loan suck. Okay, I just want to prepare you guys. It's very, very hard to qualify for. Well, not very, very. It's more stringent to qualify for this than maybe just the Fannie Freddie loans. Okay. But the reason for that is they want to make sure that the right people are utilizing it, and the
Hmm.
numbers have to work. Because you're right, if you've got this line of credit for, $1 million and you only owe 250,000, those there are people that may say, well, what do you mean my account's overdrawn? I still have checks left. That kind of thing, right?
Hmm.
So um, if you're going to use this to satisfy a lifestyle and go on vacations and buy a new boat, and right, because you now have all this access, yeah, that's going to be a problem probably for you. Not to say that you couldn't do those things with it, but the math has to make sense on the other end.
Hmm.
Very good point, Tom. Yeah, you've got to be disciplined and look at what your spending is, and know that you're a good fit for this in advance. And we do all that work up front.
Hmm. Floria asks for clarification, and this kind of goes into what you're saying. She says, why are pre-retirees the ideal candidates for this? Probably because they have
Because
more
you still have
income.
income. Yeah, you still have income. There's plenty of retirees, especially those that have investment properties and they've got those access to those gross rents and that passive income that just kind of builds, or post retirees that have chunks in their retirement account, depending on
Hmm.
what you're earning, right? Because you got to do that math. If you're earning 10%, if you are, I want to know what your investments are. If you're earning 10 plus percent, right, you're probably going to let that stay there. But if you have other investments that, are modest in their earnings, maybe you want to take some of those and drop it in here and just save and have
Hmm.
access to that line of credit. The other thing too is that a post-retiree, unless they're going to be utilizing it for, I mean, if they're just going to utilize it to save interest, fine. If they have the means to do that, if they have the idle cash to do that, that's fine. But I would say that the post-retiree probably is going to like this better if they're still going to invest in real estate and have access to that line of credit, because the other value adds of just having that access to invest is huge for them.
Hmm. Yeah. I mean, I just had a thought too, because I was speaking with someone the other day who was looking at a, 7-year time horizon of when they wanted to be, retired, and they wanted to try to start investing to create a certain amount of cash flow, within that 7-year period to offset Social Security and other income. Um, I could see this loan program being a really great accelerant to a retirement plan that's on the near horizon, because it gives you the ability to reduce an expense. One of your biggest expenses in most cases would be your mortgage, right? You could play with that calculator and see like, okay, in an 8-year period, I can pay off this $1 million primary that I live in completely. And so now maybe I don't need $5,000 of cash flow, to hit my goal, because
Right.
I've eliminated a mortgage in that same period of time.
Absolutely. 100%. You're
Okay,
in control.
yeah, there's a couple people who are like surprised that they hadn't heard of this. Like, is it new? Like, and someone asked, like, why isn't everybody doing this? What's your answer to that?
Because they don't know about it. It's not mainstream.
Hmm.
I started to talk about it. And I think there's some valid and not even conspiracy theory. So the government-sponsored enterprises, GSEs, Fannie Mae, Freddie Mac, you guys, those are the loans that we're sort of preconditioned to understand in this country. And to remove those and the interest that is paid on those and the secondary markets and the mortgage-backed securities, I mean, it's a full circle when you think about even your own retirement accounts, 401ks, for example. You guys know that your 401k is utilizing or housing mortgage-backed securities in it. Did you guys know that? So what you're paying yourself back in retirement actually has to do with, some of it anyway, is going to be based on those bonds. Um, uh, so it probably is entirely about that. And it's more complicated. So it's not the kind of thing that people can just hear and understand, right? Most people hear this and they think, oh, that's a sham, that's a scam, or there's some nefarious underbelly of something, so they just dismiss it automatically.
Hmm.
I, I guess I would draw to that to say that's probably why.
Yeah. Yeah. Anytime I think someone starts hearing strategies that require you to link your checking account and
Right.
then put everything on a credit card, and like, but they stopped listening there and didn't
Sure.
hear about the
Yeah, they
upside
shut
of
they
it.
shut down. Yeah.
Kaylee, I know you're a busy lady and we're over the hour. Do you have an extra 5 or so
Yeah.
minutes
Oh,
to
I'm
hit
I'm
somebody?
good. I'm totally good. Yep.
Okay. Um, is there a 30-year draw on this?
Yes. It is a 30-year. So let me go back to that part. This is it, and I love this feature. It's a 30-year line of credit, you guys. You will have access to this line of credit for 30 years if you were to keep it. And I know one of the follow-up questions to this is going to be, well, what if my home appreciates? Can I have more of a line limit? The only way you can extend or increase that limit is to do a full refinance. Okay, so whatever your limit starts with, that's what you're going to be stuck with unless you refi and increase it. But you have access for 30 years. What happens is, remember, your balance, okay, the balance on the line of credit and the limit, the balance can never be higher than the limit. What you owe, what's outstanding, can never be higher than what that limit is. So knowing that, how the repayment works is that in the first month of year 11, the limit will start to reduce by a factor of 1/240th%. Okay, 240th is the equivalent of months in the trailing 20 years. First 10 years unchanged. The final 20 years, or 240 months, means that the limit will start to go down by 1/240th%. Your balance can never exceed your limit. Here's the round math example that I give. Let's say you start with a limit of $100,000, okay? In the first month of year 11, the limit's gonna go down by 1/240th, so now your limit is 99,760. That round math, 240 bucks off of 100 grand, 99760. So because the limit will start to go down extremely gradually and what you owe can never exceed that, that's how that repayment would work. But you still have full access to it based on those
Mhm.
terms.
What happens when all the principal is paid off? Do you lose the ability, or does it can
So
sit there suspended for the full 30 years? Oh,
30 years. Yeah, if it's, I mean, yeah, you just have a free and clear line of credit. Now that limit will continue to drop a little bit month after month, but you still have full access.
okay. Matt's question is, if after it's paid off, do excess deposits then generate interest income?
Um, I'm gonna have to check. So the two, just FYI, Matt, you could probably find this online. Merchants Bank or North Point Bank. Those are the two FDIC insured depository entities that will house this loan. It'll be one of the two when we sell this off our line. I'm gonna say maybe. I don't know, actually. I don't know if
Yep.
deposits, they may have something, but it'll be akin to what you would get on just a traditional 1% or
Loans.
whatever it would be, yeah. So if there is, it's going to be nominal.
Yep. Okay, couple questions. Guys, we are recording this, so if you join late or you need to hear this a second time, which you probably do, it took me 3 or 4 times to get it. And
Me too.
frankly, it took me playing with the simulator before the light bulbs really came on. So we'll get this replay edited up on Caeli's page on our resource drop-down menu by tomorrow. Okay, are these accounts FDIC insured or otherwise protected?
Yep, exactly as any other FDIC insured account. The follow-up question to that a lot of times people will ask, since I'll just throw out there, is the interest deductible in the same way as it would be on a 30-year fixed mortgage? 100%. So the IRS rule is about deductibility of interest. If it was used for home improvement or investment purposes, absolutely deductible. If you did a cash out refinance and went on a 2-month trip to Europe, you're not supposed to deduct that. And that would be the same rules with the all-in-one. If it's used for home improvement and investment purposes, same interest deduction on this as you would on a 30-year fixed.
Okay. Stephanie wants to know, are you able to take this out in an LLC, in an entity?
Good question. So Stephanie, the loan is going to close in your individual name and title will also close in your individual name. Should you decide to execute a quit claim deed and put it into your LLC, you can do that as long as you are the majority owner of the entity.
Okay. Let's see here. Some of these have already done. The difference between the primary and second home line of credit. What was the loan to value difference between the two?
On a purchase, I'll just, actually, I don't know if that's the same. So on a purchase, owner occupied can go to 90. I think a second home can go to 90 as well. On a cash out refinance, I think it's the same. I think owner occupied and second home are the same, 80% on a cash out refinance. It's the non-owner occupied when we're talking about leverage that changes to 70 and 75% depending on if it's cash out or rate and term or purchase.
Okay. All right. This person says, what about building a primary home? 3 million is the appraised value, 1 million loan amount, any special requirements, and how does the draw work?
Uh, if it's for new construction where you need a construction loan, this won't apply. But if you're replacing a construction loan with the all-in-one all day long, 90% of the ARV should be acceptable. And the draw will be, you'll pay off whatever the existing balance is with this, and that's where you'll start.
All right. Oh, here's a good question. And I thought of this too. The commingling of business income and expenses with personal. Doesn't this go against the cardinal rule of keeping things separate?
I don't, that's not an IRS rule that I'm aware of. Okay, somebody feel free to challenge me on this, but I think unless it's a S corp or a C corp, I don't think that there is any commingling. If we're talking about just the rental properties, if they're in an LLC, chances are you're not even filing a business tax return for those. And if you are, I've got thoughts on it that we should talk about because you're doing yourself a disservice, and that's the whole other thing for underwriting purposes. But no, the commingling thing, I think it's more the CPA wanting you to be more organized so it's easier for them to do their work. Otherwise, unless it's a trust account that we're talking about, or like I said, an S corp or a C corp, um, the commingling is not an IRS rule that I am aware of. And the banking
Okay.
features within the online banking features, et cetera, I believe you can sort by different activity anyway. So there is I mean, I guess, that might be something that someone could draw to say is
Hmm.
a deficiency of this,
Hmm.
that you are taking everything and it's now going in here, and the accounting
Hmm.
is going to be in this one account.
Yeah, I would talk with your attorney too about if you're
Yeah,
worried about like piercing the veil, right? And having if you own the rental property in an entity and they've advised you to keep the banking very clean to just keep it separate from you. I mean, talk to them about their thoughts on this and um, if this is something you shouldn't do or if it does change any liability to you. Okay. Let me see if there's any other here that are good. The more we ask, the more come in. Uh, Okay, here's a good one. Are there any minimums or maximums on the loan amounts?
minimum draw is 100,000. I think the maximum's 3 million, I think.
Okay. All right. Okay, an exit strategy. What happens when you sell the primary home while you're utilizing this loan?
It just same as say it's no change to that versus a 30-year fixed. It just pays off. If there's a balance, it'll be repaid upon the sale, and whatever proceeds are left over, you would get in the same way. So no difference between this and a traditional mortgage being paid off on a sale.
Awesome.
No
All right,
prepayment
Caeli.
penalty.
No prepayment penalty?
No prepayment penalty ever. No, not on the all-in-one. So nothing like that to worry about.
Excellent. Listen, we put the link to the simulator in the chat. So if you haven't already, our hope was that you wouldn't pull up the simulator and be doing that while we were while we were talking, so you'd listen. But
Smart.
we've got the link in the chat there. And then Shaylee, you got your contact information up here. What
Sweet.
should people know about like reaching out to you if they're interested in doing one of these?
I would say, guys, I would really like to play with the simulator. Okay, email us at info there as you see if you want more information. We've got an FAQ sheet that we can send you real quickly. There's a highlight page for all the qualifications for the all-in-one. But for those of you that are really interested and you just want to make sure you've got another set of eyeballs on it, I'd love to do the simulator with you. We'll get on a Teams call. We'll share a screen. We'll go over, and then I can help make sure that the input is accurate. Because right, bad input, invalid results, and then I can help you interpret those results too. So for anybody that really wants to dig into this, let's do the simulator together.
Yes, awesome. Well, Shaylee, thank you so much for taking some time to educate on this. Really a powerful tool. And again, for those of you who've been looking at all the equity that you've got in a property, I think this is absolutely a loan product that you should be considering. See if it works for you.
My very favorite.
Shaylee, thank you. We'll have you back again soon, okay?
Okay, thanks, Leah. See you guys.
Bye.